Okay, so hello everyone, and welcome to the November edition of the NERI Seminar series. Today we're very lucky to have Dr. Barra Roantree with us. His paper will be called Options for Raising Tax Revenue in Ireland. Barra is an economist whose work is focused on taxation, welfare and pensions. He joined the ESRI in autumn 2018 after completing a PhD at University College London under the supervision of Professor Richard Blundell. He previously worked as an economist at the Institute for Fiscal Studies in the UK. So Barra today will speak for somewhere between 20 and 30 minutes. That will be followed by a question and answer session. The question and answer session will be based on Chatham House rules. And to be clear, people asking questions, do so through the chat function. Let us know who you are so we can attribute the questions and we will come to them one by one, perhaps. And just to say as well that we intend to go for potentially 90 minutes, but it could be shorter. We'll see how the event plays out in terms of in terms of the Q&A session. So I'll leave it at that. Barra, if you're happy to go and share your screen, we'll take it from there.
Brilliant, thanks a million, Tom, and thank you for inviting me along to present today. Let me see if I can get these up and running. That's showing up okay there now for everyone, Tom?
Yeah, it's perfect for me, Barra.
Great, thanks, Will. So yeah, thank you very much again for inviting me along. I'm just going to talk you through kind of some of the main findings from a report that we published at the ESRI earlier this year, back at May or April or something like that. Budget Perspectives paper, which, as the title says, looks at options for raising tax revenue in Ireland. This is joint work with my colleague, Dr. Tiano Kakalutu. So I'm just going to give you kind of an overview through the findings from that and just some of the options that we discuss and some of the context for this. And then very happy to take questions. Just to make clear as well through this that this, these are all obviously the author's own views. They don't represent the views of the Commission on Tax and Welfare, which I was subsequently appointed to along with Tom. So just to make that clear, and I think as you'll see, we're kind of the paper very much is about assessing the various options that are there, and it's not advocating or pushing for any in particular. Hopefully that comes across clearly in the paper, but very much just to say that at the outset. So the motivation of the paper is that really framed around that there's likely going to be a need for higher taxes in the coming years. That's kind of where we're starting from. The reason, we'll talk about this a little bit in the paper, but the reason isn't what's happened over the last few months in terms of COVID. So we have seen spending rise from about 87 billion in general government terms in 2019 to 106 billion in 2020, about 105 billion now for 2022 it's forecast to be. And that kind of, that was revenues didn't increase by that much, so we financed that through a deficit. And that sort of deficit finance spending is exactly the appropriate type of response to a once-off shock like the COVID-19 pandemic. And kind of try to just make clear in the paper, we're in no way suggesting that this kind of fiscal stimulus or deficit finance spending should be withdrawn prematurely. We're not talking about raising taxes in the coming year or two or three, even further. Rather, what we are focused on, and what really motivates this paper, is that we know that we think that there is likely going to be a need for higher tax in the coming years. So one reason for that is that demographics are going to increase the cost of providing existing services. So the Irish Fiscal Advisory Council published a report, again, at the start of this year, the Long-Term Fiscal Sustainability Report, where they show that, on basis just of even existing services, just demographics are going to mean that pensions and healthcare spending are forecast to rise from about 13.3% of GNI to 25% by 2050. So that's a huge increase in economic activity, and that's just for the existing level of services. And we know that things like healthcare in particular, it can be subject to costs well in excess of inflation, and that also kind of demand for healthcare grows with income level, and it's something that we want more of, the richer as a society we are. So again, that's just in terms of existing services. It's not inconceivable that the demand and pressures in the healthcare system might go beyond that. On top of that, we also had big commitments in the programme of government back in 2020 to reform the health system, to expand social welfare entitlements. So not just the existing level of services, but to expand what the state does. And that's something that is not just the current government are talking about. If you look at most manifestos for the the opposition parties, there very much is a focus on increasing what the state does, and that's going to cost money. And again, so this isn't about the temporary COVID-related deficit that we're experiencing. That's not what we want this paper framed around. It's about the longer term. And finally, a reason that we might think that higher taxes are needed in the coming years is that we have an existing potential over-reliance on certain types of taxes. Corporation and motor tax receipts stand out. So corporation tax, we all know the issues there, that we get a lot from a very small number of multinationals who are potentially quite mobile, or kind of subject to what goes on in the international corporation tax regime. Could be more developments there, and so it's not necessarily clear we'll have those revenues into the future. On motor tax sides, there's about in excess of 3 billion at least currently of receipts which come from motor taxes and which come from essentially the burning of fossil fuels. And that's something which isn't going to persist into the future according to government policy. So those are revenues which are going to disappear. And so that in and of itself is potentially billions of revenue that we currently raise that we are unlikely to have in the future, which again suggests that there's going to be need to raise tax revenues elsewhere. So that's kind of very much the framing of the paper. And just kind of I think it's worth setting that out, that we are talking about the long term and kind of permanent increases in spending, not the temporary kind of day-to-day deficits that we're running for COVID or for other kind of economic shocks. So that's kind of what the framing of the paper. And what we do then is we set out, we analyse, but we don't advocate any particular options to raise tax revenue. And so again, just what we're not trying to say that anyone should do this. Ultimately, what options people want to pursue depends on their political preferences for distribution, for even what group they might want to favour, and that's not something that we, I think, can have any real opinion on, certainly not at the ESRI. So rather, we're just going to try to set out that here will be the effect of this option. This is how much we raise. This is some of the economic consequences, and that's kind of the frame I want to talk to you about some of these options through today. First, just want to give you a bit of context. So Ireland raises a little bit less in taxes than it used to. So what I'm showing you here in this figure first is tax revenue as a share of GDP, and what you can see is that just declines particularly sharply over the thousands. But we all know the problems with GDP. GDP is not a good measure of economic activity in Ireland. One just way to maybe convince you of this is, does anyone really think that tax revenues as a share of economic activity dropped by 5 percentage points? And what's that, about a fifth from 2014 to 2015? They didn't. That's because of the very large revision to GDP that happened in that year. And so, this gives a bit of a misleading picture, as does looking at anything as a share of GDP. Instead, if we look at it in GNI Star, which tries to strip out some of these measurement essentially issues with GDP, and if we look at that back over time, what we see is that actually it's fluctuated at around quite a relatively steady level, but it's a little bit lower than it used to be. So if we we take the average before 2000, that's that red line there, so we're talking about 34% of GNI Star. And if we take the average after 2000, we're talking about 33%. So we're raising a little bit less in tax revenue than we used to, but it's not massive. And again, don't look at GDP for any kind of guide on this. And this just shows how meaningless GDP is as a measurement of really anything, and particularly when you're talking about like orders of magnitude of how much do we spend on something or how much we raise on something. We really shouldn't be looking at GDP. So while we raise a little bit less in taxes than we used to, we actually raise a little bit more percentage of economic activity than the OECD average. So what I'm showing you here is just taken from the OECD Global Revenue Statistics database. And again, here's Ireland as a percent of GDP, how much we raise as government revenue share of economic activity. Definition of revenue here is a little bit different from the national accounts different, but it's harmonized across countries. So that's just why the numbers here don't perfectly align with maybe the data point you were looking at in the previous slide. But what you can see again is, if you looked at GDP, you would say, well, Ireland is down there with Chile, Turkey, United States, in terms of how much it raises of economic activity and taxes. OECD average is about 34% on this basis, in this definition of revenues. GNI Star were about 36%. So we're up there with Iceland, Slovenia, Hungary, Germany, are kind of the ones that we're very similar to. We're a little bit below Netherlands, and that we're quite a bit below Denmark and France, but so are most countries. But again, this is just kind of giving the context for we raise a little bit less than we used to. We're a little bit above the OECD average, but we're still well below a lot of those maybe Western European countries that one might perhaps sometimes hear people seeking to emulate. So we do raise less as a share of economic activity than those countries, but a bit more than the OECD average. So that's just to give you some kind of context for that. Where do we actually get our revenue? Well, 4 main sources actually is where most tax revenue comes from. So About a third comes from income tax and the universal social charge, about 22% from VAT, and then PRSI and corporation tax both raising about 15-16%. This is, I think, in 2019, so before the pandemic hit. But again, this just gives you a sense of, we really raise most of our revenue from those four big taxes. Raise another 9% or so from excise duty and customs, capital taxes, and that includes capital gains tax, capital acquisitions tax, and the stamp duties at 4.5%, and then local property tax about 0.7%. So that could just give you kind of, again, some context for where do our revenues come from, and we might come back to this and then essentially a little bit later, because what I want to look at first is, well, given our revenues come from three big and then this maybe temporarily overly inflated corporation tax category, well, one way of getting more revenue is just very simply from those to raise one of these big three taxes. And so they're the first set of options we want to look through. Then I'm going to talk about some options which are maybe a little bit more targeted on certain groups. And I'm going to finish up by looking at kind of some tax reliefs a little bit in that dimension. So first, look at these kind of broad-based tax increases. So you can raise a lot of revenue from increasing rates of tax on personal income. So what I'm going to show you here is how a bunch of different 1 percentage point increases on income tax, USC, and PRSI would raise across the distribution, right? And so here I'm going to be breaking households into deciles, so 10 equally sized groups, where I'm arranging them from lowest income on the left to highest income on the right. I'm going to show you how much each decile would lose on average from these kind of tax increases. So if we look first at just income tax, you can see we raise about $1 billion from putting a percentage point on both the standard and the higher rate of income tax. That's going from 20 to 21 and 40 to 41 on that. And that raises about $1 billion. Likewise, if you put 1 percentage point on each of the USC rates, you'd raise about $1 billion as well, a little bit less than that maybe. And then about 810 million from the employees, mostly Class A, and self-employed, mostly Class S, PRSI. So each of those are going to raise, not dissimilar amounts. Kind of, you're talking around $1 billion from a percentage point on those minimum rates. And who do they raise it from? Well, let's look first at the income tax increases. So you can see by just increasing the standard rate, that 20% of income tax, that actually there's those in the lowest three income deciles, lowest about a third of the population, would lose very little on average, so about 0.3% of disposable income. And the reason is very few people in those in households in that part of the distribution earn enough to pay income tax, right? So they don't earn more than 16,000, say, so they're not going to be affected by an increase in the standard rate. You can see then the losses as a share of disposable income grows the further up the income distribution you get, until about decile 8 or 9 when it starts to taper down. And the reason for that is essentially that these people in deciles 9 and 10, the highest income decile, more of their income is subject to the higher rate of income tax. So essentially the most that they're losing is 1% on whatever's in their standard rate kind of band. And so that's why you kind of get this distribution pattern kind of tailing off. But it is really, even the standard rate of income tax, if you're increasing that by a percentage point, it really is the highest income half of individuals that are going to bear the burden of that. If you look at these two combined, if you did them at the same time, well, you can achieve a straightforward progressive pattern. A little bit of a blip here, and that I think there's a little bit of pensioners in here, and they have an age-related kind of greater allowance there, so they see slightly smaller losses. But really, what you do see from this is that if you increase income tax at the standard rate and the higher rate, you can achieve quite a progressive pattern if that is what you're seeking to do. On the universal social charge side of things, again, raising a similar kind of amount, and you get a similar type of distribution pattern by a percentage point on each of these rates overall. The base is a little bit different between these things. So USC is still charged on pension contributions, whereas income tax, you have tax relief in that. So there'll be a bit more difference there. The big difference, I suppose, then is with PRSI. So again, PRSI, you're raising about the same there. And what you see is here that is actually you raise a little bit less from deciles 2 and 3 in particular. And the reason for this is because quite a lot of those who are retired are in that part of the income distribution, and they don't pay PRSI, Class A or Class S. For the most part, once you're above the state pension age, you stop paying PRSI until you're therefore not going to be affected by any increase to those rates. But again, this just to give you a sense that these broad-based taxes on personal income, you can increase just by changing the rates. You can raise quite a significant amount, around $1 billion, and you can also do that in such a way that you can achieve whatever really distribution pattern you want. If you wanted to make this less progressive, you could adjust the bands as well. You could bring more people into the income tax net at the bottom if that's what you wanted to do. But this is really, I suppose, just to highlight that there's actually a lot of flexibility in raising money through just the standard taxes and personal income, and you can have a lot of control over who pays and who doesn't from that. But and you end up you can raise a lot of money. So that's really just kind of the where I'm coming from on that. Another broad-based tax increase is that on VAT, value-added tax. So what I'm showing you here is what increasing the standard and reduced rates of VAT by 1 percentage point would raise, so across the income distribution again. So again, you're talking about, 700 million or so being raised by that. But again, the difference with VAT here is if you look at it as a percentage of income, you're taking a higher proportion from lower income households. And now this gets a bit, I think, tricky here, because actually the reason that you're getting, in particular in the lowest income decile, these large losses as a percentage of income is because many people in this kind of distribution are spending more than they have an income. So that's why those losses are so particularly large as a share of their income. But they can't do that indefinitely. Lots of the people here in the lowest income decile group is a kind of a funny mix of people, but lots of the people here are experiencing temporarily low periods of income. And so they can't do that indefinitely. You save kind of dying in debt. You can't spend more over your lifetime than you have income over your lifetime. So this is perhaps, we argue in the paper going to this a little bit misleading. One way of kind of getting around this is to look at maybe the loss as a share of expenditure. And the reason for you might want to do that is because maybe you think expenditure is more closely aligned to lifetime income. And so there's an argument for looking at it in those terms. And if you do that, really well, the increase in VAT looks pretty actually neutral across the distribution. It's taken around 0.4% from each decile. Still ranked on income, but here we're looking at just the change as a percentage of expenditure. So again, we go into this a bit more in the paper, but we just kind of wanted to push back a little bit against the maybe common conception that increases in VAT are progressive. It's not necessarily the case because of that difference between income and expenditure. However, it is the case that raising revenue from VAT is less progressive than will be through income tax USC or PRSI. And the reason for that is simply because there isn't essentially the equivalent of a tax-free tranche of spending that you don't apply VAT to. There's no PAYE, a personal tax credit for VAT. And that's why it's never going to be as progressive as income tax, USC or PRSI. But I think it's a bit misleading to think of increase in VAT as regressive. So that's just to raise that point there. There's other options for broad-based tax increases. So one is to increase excise duties and carbon tax. So 10% rise in all rates of those, and we're publishing this paper would raise around 600 million. Here, actually, with excise duties and carbon tax, the burden is bigger for both lower income and spending households. And the reason for that is because the lowest income households tend to spend a lot more of their budget on items which are subject to tobacco duty or to the carbon tax. Heating makes up a larger share of their spending. So in isolation, that kind of tax increase would affect those families and households more. But there's, I think, a larger question around, excise duties and the carbon tax, really their principal rationale is supposed to be addressing externalities rather than raising revenue. And so there's kind of a tension between those two objectives, particularly, say, in terms of the carbon tax. It's not really something you want to rely on in the long run in terms of revenue, given ultimately our goal is that we don't have any net carbon emissions. So there will still be some revenue in the longer run, but we certainly shouldn't, I think of that as a long-run revenue raiser. It's important along the transition, both to raise money to fund other sources, and also to provide, more importantly, a price signal for that adjustment for both firms and individuals to know that fossil fuels are going to get more expensive, so we need to switch away from them in how we consume and how we produce. But they're maybe not particularly well suited for raising revenue. They're better suited for them addressing that, what we call the externality. Similarly, in terms of excise duties, alcohol duties, for example, or tobacco duties, it's not really clear that they should be treated as the old reliable that they sometimes are, if again the goal is to kind of address something to do with public health in the case of alcohol or tobacco. So we're a bit kind of cautious about the idea of raising more from them, just because it's not necessarily clear it's sustainable into the longer run, or that's what these instruments are best placed to do. Increasing local property tax is another broad-based tax. We're currently moving from 2013 to 2021 property values, which is very welcome and long overdue. That's something that gets increasingly hard to do the longer you leave it. So, and it makes very little sense to be charging a tax based on the 2013 valuations of properties and excluding newly built ones. So there's kind of a horizontal equity point, an issue there. So that they're bringing the newly built owner-occupied dwellings into scope as well is welcome move. At the same time that that's happening, the rate is being cut to maintain the yield at around 500 million a year. And so that, we're not actually raising more from the property tax. There's, the valuations are changing, so the distribution of the tax burden is changing. But actually, in real terms, we're not raising anything more from this, and then maybe a little bit less, particularly given we're bringing in a whole bunch of new houses into scope. And just to kind of illustrate that and illustrate, well, in comparative context, actually, the local property tax is quite small. So the average payment in 2020 was €243. And that compares in England to the average council tax bill of 1,385 a year, or even for rates up across the border in Mid-Ulster, there's an average bill there on domestic rates of £990. So again, those are quite a lot larger than our average payment for local property tax, and that kind of gives you a sense that, well, there is perhaps scope there to significantly increase the amount of revenues. We currently raise about 500 million, but the average bill is something of the order of a quarter elsewhere. Like that just gives you a sense of scale that there is potentially, through increases to local property tax, scope to raise quite a lot of revenue there. And that's maybe just something for I suppose people to consider into the future. That this is, and I'm going to mention this in our conclusions, that this really is something where it looks like one of the easier ways to raise significant amounts of revenue, and particularly when you kind of think about the other effects of a local property tax and kind of how it interacts with financial stability. In that there's maybe an argument for a property tax from that point of view as well. So again, we discussed that a bit more in the paper, but that's something where maybe there is a bit more scope to raise revenue than necessarily excise duties and the carbon tax, say. So they're kind of the main broad-based tax increases that we kind of consider and analyse and go through. And again, I'm just giving you kind of a quick overview here. I'm not going into too much depth, but there is a lot more in the paper. And so if you can bring yourself, do download it off the ESRI website, maybe have a read through. Corporation tax is one thing that actually changed quite a bit since we maybe wrote the paper. Still fundamentally, I think one of the big issues here is it's unclear what increasing the rate of corporation tax could actually yield. So we know that receipts are highly concentrated amongst a small number of firms. In 2019, it was 51% from just 10. And what that just fundamentally means is that the yield from any increase in corporation tax is going to be very, very sensitive to the decisions of these firms. And that's something that's just very hard to know. We can't know that, what the effect of increasing our tax rate, corporation tax rate, is going to be in these firms. It's just very, very hard to tell. And that in and of itself, is perhaps just one kind of factor to take into account on this, is that it's not necessarily clear how much more revenue we can raise from this. There's no estimates published by the revenue commissioners, and I think it's very hard to know what we could actually get from that. So it's just again a kind of note and caution about how much there might be on this. And given as well that we're also over reliant on corporation tax already, it's not necessarily clear that strategically you might want to increase one's reliance on corporation tax by increasing the rate. There maybe is a bit more scope to raise revenue in terms of corporation tax from the smaller firms than the non-large multinationals. But that would appear to be a reversal in what is our new policy, seemingly announced kind of articulated over the summer, of having a lower rate, of maintaining the 12.5% rate for these firms. So we can discuss that. We're going to go to having a 15% rate on those large multinationals. But we're going to keep the 12.5% for smaller companies who fall below a certain revenue threshold, seems to be the suggestion. So it's, that in itself is a departure in policy. We always try to essentially tax the elastic mobile stuff less, and then the goal was, I suppose, to bring that the FDI that they would generate to Ireland and kind of get employment and tax revenue through the employment, rather than necessarily seek to get revenue off those firms. But now we seem to be kind of going in a different direction. So it's, while there might be some scope to raise revenue from those smaller firms, given they just tend to be less mobile, that would seem to go against the current thrust of policy. And it's worth saying, again, we can go into the paper here on this, that increasing the rate of corporation tax would have other economic effects. It's not just a cash cow that is there to raise however much revenue we think we might want or need in the coming years. So increasing the rate of corporation tax would discourage investment, both foreign and domestic. It reduces the rate of return on investments by reducing the after-tax rate of return, which is what ultimately shareholders care about. So it's going to have an effect on investment. Unclear of what magnitude, but it is something that needs to be borne in mind. There's some research on that and suggests it can be perhaps substantial. So it's again just something to consider in the mix of think about, well, do we want to raise corporation tax? That's one of the big questions I suppose you need to grapple with. And in addition, this is something that maybe doesn't get talked about as much, but a lot of very good economic research now, in particular, come out of the last few years, and much of it actually European rather than American, showing that some of the burden of corporation tax does fall on workers, consumers, and retirees, because a lot of retirees tend to be the owners of pension funds, which own the shares of companies. And there's corporation tax isn't economically incident on a corporation. A corporation is just a vehicle. It doesn't bear the incidence of this taxation itself. There's going to be some combination of workers, consumers, and firm owners who will bear that burden instead. And the research does suggest that a significant share of that is on workers and consumers. So that's something to kind of bear in mind as well. It's not necessarily clear from all the policy discussions that is the case, but it is something important to bear in mind when considering this option. Another option is to focus tax increases on higher income people. This is something that I suppose that's often discussed. We talked about a few different ways one could do that and go about doing that, and some of the difficulties with that. Here, just showing the distribution impact of a few different options there. So there's a 1% rise in the existing USC surcharge on non-PIY income. That would raise very little, about 14 million for each percentage point increase. You could introduce a kind of equivalent 3% USC surcharge on PAYE income, which currently doesn't have the equivalent above 100,000. That would raise about 110 million. Or you could also introduce a new 43% rate of income tax that match just because of 3% USC surcharge. That's the only reason you can go for that. And if you did that above 100,000, it would raise something about 315 million. Each of these will have slightly different distribution effects in that, well, one, they raise different amounts of money. They're all raised from the highest, so you can see that's the 1% rise in the surcharge, that's a new surcharge, and that's the new 43% rate of income tax. So, you raise most from the 43% rate of income tax. That's in part because a lot of couples are jointly assessed, so you get more couples with taxable income above 100,000 than you do, I suppose, individuals with USC income above 100,000. And then likewise, there's a lot smaller number of people with non-PIY income, even in the higher income decile. So this is just to give you a sense that, all of these would raise money from the highest income groups to varying different, they'd have little differences between them. There will be some differences in who's actually bearing the burden there. But one thing that we kind of again discussed in the paper that, well, when you start focusing tax increases on higher income people, we know that they are a group who have a greater ability to respond. And that's because they currently, as the system is set up, maybe have more scope to change the form in which their income is taken. And as a result, that's just kind of maybe a natural impediment to just how much you can raise. Now, there's things you can do alongside. If you did decide you wanted to increase taxes on higher income people, you really would want to look at changes to the tax base as well, and changes to capital gains tax and how that's done to kind of minimise the ability for people to shift over their income. But it is something we know from economic research, both in Ireland and abroad, that higher income people tend to be more responsive. So that just does, those yields that I've shown you here don't account for behaviour responses. Behaviour responses are more important if you're going to focus those tax increases in higher income people. And behaviour responses become more important the bigger the tax increase gets. It's not a linear relationship between responses and tax increases. The bigger the tax increase, the larger the behavioural response is likely to induce. And again, we can go into some of the research around that in the paper for those who are interested. There's also maybe, what's talked about is focusing tax increases on those with lots of wealth or inheritances. So we talk about a wealth tax in the paper a bit. I think there's an important distinction maybe between a once-off wealth tax and a permanent wealth tax, a permanent recurrent tax on wealth. You can make a very good case for a once-off wealth tax. There's work done by the group called the UK Wealth Tax Commission, which have kind of gone into this and have produced a really valuable set of papers on how one can go about doing it, on addressing some of the tricky valuation issues, and also just the economics around this. And to the extent that it is credibly once-off, if you did have a once-off wealth tax, that's not really likely to change people's behaviour. If people credibly think this is likely to be once-off, there's an issue of how credibly you can commit to doing that, but there is nevertheless, I think, a good argument there, and the Wealth Tax Commission is, I think, a really good source on that for those who are interested. If you want a recurrent wealth tax, though, I think there's a different set of issues there. So that's more likely to be relevant if one's thinking about funding revenue into the future, which is really in the context of this paper. But in order to raise serious revenue or significant revenue, even from a wealth tax, you would really need to have very few exemptions, or you'd have to set it at a very, very high rate. And that's something which I think raises two separate issues. So the first issue is if you're going to have large exemptions, in particular if you're going to exempt residential property, well, that's the majority of household wealth. So there's a paper in the Economic and Social Review earlier again this year by some economists at the central bank, Horan et al. And they show that the majority of household wealth and right across the distribution is held in the form of property. So it's, if you're going to exempt residential property from wealth tax, you're already going to struggle to raise much. And that's a point that was well made in a paper by my colleague Martina Lawless and Don Lynch then of the Department of Finance, I think. And they estimate that there'd only really be a 53 million euro yield from a 1% wealth tax, which is quite a hefty wealth tax, I should say, if you applied it only above wealth of 1 million per adult and excluded the principal private residence, farms, businesses, and pensions. So, and that still involved grappling with a whole difficult set of valuation issues and all the rest of it. But if you start exempting lots of sources of income or giving a large exempt amount, you're not going to raise a huge amount from a wealth tax. And then there's also the question, well, if the majority of household wealth is held in the form of property, well, we already do have a tax on property, so maybe you might be better off looking at adjustments to that rather than necessarily introducing some kind of new tax on wealth. There's maybe more scope, as we can discuss in the paper, to raise taxes on the transfers of wealth. So again, this can be quite an emotive issue, looking at capital acquisitions tax and that paid on inheritances. But actually, if you look at kind of the number of reported liabilities for capital acquisitions tax from inheritance, so arising from a death, it amounts to less than 1 in 2 deaths. And given that we know that there's multiple, often inheritors associated with the death, it really looks like there's much less than 1 in 2 deaths lead to an inheritance which is subject to CAT. So capital acquisitions tax, that tax on the transfer of wealth over your lifetime, looks like it is really paid by people receiving quite significant inheritances. And another way of looking at that, you can back out again just from the stats the revenue published, that the average payee in 2019 of Class A capital acquisitions tax had a liability of about 90,000. Now, in order to have a liability of 90,000 under Class A CAT, you would have needed to exceed around 600,000 euro of gifts from your parents, that's the Class A one, or less common, but from children to their parents. So really, it looks like the people who are currently paying capital acquisitions tax are receiving some very, very large bequests. So again, on the average payee, if you look at how much was paid, had received more than 600,000 in order to get to that level of liability that revenue publish. So that's quite striking. That even though there's lots of discussion about CAT in the family home, really the situation with CAT is that it's paid by a small number of people receiving a large amount of inheritance. You could bring more people into the net. That's actually one way that would be effective to increase the amount of taxes that you raise from there. So just as an illustrative example, if you reduce the tax-free threshold from 335,000 on Group A from parent to a child or vice versa to 250, you'd raise about 63 million. And now you could get more if you accompany by rate increases, restrictions. So that's not you're only bringing in people who are still receiving over their lifetime more than 250,000 in gifts, and you're starting to get into the territory of kind of significant amounts. There's also a lot of reliefs from capital acquisitions tax, and this is something we can maybe just finish up by looking at now, something we talk about in the paper. We have a lengthy section about tax reliefs and how well maybe directed they are towards their intended aim, and would encourage you again if that is of interest to look at that. Or indeed, I think we gave evidence to myself and Tiano and Dr. Neil Collins and UCD. We gave evidence to the Budgetary Oversight Committee during the year and during the summer, which was kind of focused on tax relief. So if that's your thing, or if you're interested in that, do go have a look for that that maybe debate. But the kind of, I think, where we come to in terms of reliefs is that actually there's the potential to improve the design of taxes while raising revenue, and this is because many reliefs are poorly targeted at achieving their aims. So sticking with CAT, there's something called business and agricultural relief, or business relief and agricultural relief, two separate reliefs. Between them, they cost 360 million in 2019. And essentially what these do is that they allow you, for eligible assets under each of them, to reduce the amount for capital acquisitions tax purposes by 90%. Now it's not capped, so that the kind of intended aim is that it's designed to help with the passing on of small businesses or farms to family members. But actually, because it's not capped, and in combination with the 325,000 Group A threshold, what that ends up meaning is that you can pass on a farm worth or a business worth more than 3 million to a child entirely inheritance tax-free, capital acquisitions tax-free. If you have multiple children, you're passing on the business, the farm to them. That's multiplied by the number of children that you have. So if you'd have a business worth almost 10 million being passed on to 3 kids in equal amounts, pretty much inheritance tax-free. So that's a relief which is really quite poorly designed towards its intended aim, and something that there may be a scope to raise revenue from by restricting, by capping. There is very good policy rationale if you do want to encourage the transfer of small businesses and farms, then you might want to exempt a certain amount of that from inheritance tax, but that should probably be capped rather than just a 90% unrestricted relief. We also highlight, I suppose, the tax-free pension lump sum, so up to 200,000 or 25% of the value of the pension pot. That cost 134 million in 2014. We haven't had a valuation since. But that again is a tax relief which it's not particularly clear why we have that. The idea of pensions taxation and indeed of giving the kind of reliefs that we do is because we want people to save for retirement so that they have a steady stream of income in retirement. It's not clear whether the tax system should be the thing that's encouraging people to take a big lump sum upon retirement. And people do it because it's tax-free and it's exempt, but it's not entirely clear why the tax system should necessarily be encouraging that. And again, there's something we talk on the paper, along with help to buy relief and entrepreneur relief, which we kind of pick on as some examples of some tax some tax reliefs which are not particularly well targeted at what they're supposed to be achieving. Finally, just to mention this, so self-employment is a form of work which is highly tax-favoured versus employment. There's no equivalent. The reason for that is there's just no equivalent of employer PRSI, which is between 8.8 and 11.05% of pay for employees, remitted by employers. But there's now very similar access to contributory benefits. So this was always the historic reason why people argued that, well, self-employed should pay less PRSI because they don't access the same benefits. But as the Department of Social Protection in the papers in the last year or two have made clear, we have had the expansion of most contributory benefits now to the self-employed, to those paid Class S PRSI, 93% in value terms. So there isn't really an argument for a tax differential, certainly at the order, at the level that there is. So the other argument that's often put forward is, well, we want to target entrepreneurship and encourage that. And I think just the response to that is simply, well, blanket reduced rates of tax are very poorly targeted at doing that. So if there are very good reasons why I want to encourage entrepreneurship, and spillovers from R&D not being fully captured by the person who makes them is one reason you might want to subsidize entrepreneurship, so we get more kind of innovation and investment. There's again very good rationale for why you might want to do that, but having a blanket reduced rate of tax isn't a good way of doing that. So, for example, Class S PRSI is paid by some GPs and barristers, not necessarily the activities you talk about when you talk about entrepreneurship, I think. And so again, is this really the best way of doing of encouraging entrepreneurship is what we kind of question in the paper. And there's serious revenue to be had there potentially. So equalising the rates without failure response would raise something in the order of over €1 billion. But again, you would want to simultaneously look at using some of maybe the revenue raised, if you did do that, by encouraging investment, because you would, if you just raise the rates, you would inevitably discourage investment from those group of the self-employed who are engaging in entrepreneurship. But again, there's maybe something you do where you bring in some offsetting measures to really target those aspects of entrepreneurship that we want to encourage. So I'll wrap it up there and look forward to some questions, just to kind of a few conclusions. So again, the paper's kind of main point is that really there's likely going to be a need for substantial tax increases in the coming years and decades ahead. The kind of point we make is that while there's many ways to focus those tax increases on groups that are deemed to maybe better off, you're going to struggle to raise serious amounts of revenue unless you set those focused tax increases at very high rates. And then you're in a position where we know that these are the group who are better able to legally avoid those taxes, and they can maybe change the form their income is held in. They might be even more internationally mobile. There's just lots of people on higher incomes or with lots of wealth are more likely to be able to respond to taxes than those of us with less, and that is something that we need to grapple with and consider when you think about increasing taxes. So that's not to say that you can't do it, but you need to think carefully about how you do it, and it needs to be more than just increasing the rates at the top. You need a broader, more comprehensive, radical reform of the tax system simultaneously. It is, however, relatively straightforward to raise substantial euro by increasing those broad-based taxes on income, consumption, or property that kind of talked about at the start. And I think one thing that's maybe missed sometimes in the debate is that you can do that while still achieving whatever distribution goals you have. So if you want to do, you want to raise billions of euro in revenue, but you want to do it in a distribution neutral way, you could maybe do that through a combination of VAT and income tax increases. If you want to maybe target it more towards higher income households, you could do that again through maybe more leaning towards income tax and PRSI and USC increases. So whatever distribution goals you have, and again, we're not coming down in support or in favour of any particular distribution goal, but whatever one you do have, there is a way of achieving that with those broad-based tax increases. And so we're maybe a little bit, I think, the point to make is a bit too quick to rule out changes to income tax or to PRSI or to USC or to VAT, when really I think they're probably going to need to be part of the mix if we are going to have these big tax increases. And worth saying on that is, but part of the idea of this paper was to raise some of these issues so that maybe we can have that debate of, well, do we actually want to raise spending in the ways that we're talking about? If there is this cost of it, if it does need to be funded, well, then and we have to pay that cost in terms of increased taxes. Well, do we still want to go ahead with those types of spending increases that we're talking about? That's the kind of debate I think that the paper is hoping to spark a little bit. And then finally, there is a wide range of, I think, what you could fairly call anomalies in the current tax system. These create distortions, which if you just raise the rates of tax alone, you could amplify. So there really is a need to look at reforming those anomalies and those quirks in the system. And you can do that maybe in a way that raises revenue while also improving the design of the tax system. So that's, I think, something which, again, maybe gets glossed over in this, that there is a chance to improve things in terms of how the tax system as a whole is designed, at the same time as raising revenue. Again, and that's something which we shouldn't lose focus of either. So I'll finish up there, and hopefully that was not too long, and look forward to taking questions over the next 20, 30 minutes.